Thank you very much. I really appreciate you having me back on. And welcome, everybody. Glad to be with you here today. I'd like to speak to you about options trading today. This is something that completely changed my trading career once I learned how to trade options. What you'll find with options is that not only do they help you protect your portfolio and your positions, but they also help you leverage it at the same time. And you may hear a lot in the media about how risky they are. Once you know how to trade them, once you truly understand options and know how to trade them, it's actually the exact opposite. It is a lot safer than just trading stock. And a day like today is perfect for options. A day like today, again, if you're on the wrong side of it, will help you protect yourself. But when you're on the right side, it really helps you leverage those positions. So let's get into this. Again, I'm Vince Vora. I'm the head trader here at TradingWins. I've been doing this for a little over 30 years. And throughout that time, I've developed several strategies and trading systems. But today, I don't want to talk about strategies. Certainly, we have several of our own, but you can use anything that you want. What Stephen just went through with you is very effective. I consider Stephen a friend. We've worked together in the past, and he's got great systems. And if you combine those with options, I think you'll do very well. So in today's presentation, what I'm going to do is go over the basics, but I'll do so very, very quickly. Then I'll talk a bit about who actually makes money in the markets, and then share not one but two option strategies with you. Okay, along the way, if you have questions, type them in, and I'll do my best to get to them as many of them as possible. Please do remember that trading can be risky, so don't trade with real money until you are completely comfortable with the system you are using. Now, let's talk about options. And again, I'll go through this very quickly because there's a lot that I want to show you in the next half hour. So when it comes to call options, I'll let you read the description here. I'm sure you'll receive a recording as well, so you can rewatch it, pause it, and go through it step by step. But call options give you the right, but not the obligation, when you're a buyer of options, that is, to buy a stock at a particular price known as the strike price on or before an expiration date. Now, here are the things you need to remember when it comes to buying options compared to selling options. First of all, a call option gives you the right to buy. A put option gives you the right to sell. But when you're a buyer of option, be it call or put, when you're the buyer, you pay a certain amount of premium for that option contract, but that is the maximum amount you can lose. You can never lose any more than what you paid for it when you're a buyer of options. Also, when you're a buyer, you decide if and when you ever exercise that option, okay? So you're never at risk of getting exercised when you're a buyer of option. You decide if and when you do. So your losses are always limited when you're a buyer. The loss is definitely limited when you're a buyer. It is unlimited when you're a seller of options, unless you protect yourself. Okay, so remember, you're in control when you're the buyer. You are not in control when you're the seller. You are susceptible to an exercise notice, and certainly the risk is much higher if you don't protect yourself. We'll get into a little more as we go through this. I'll put up the description for the put options here for just a few seconds, and then I'll move on here. So again, the puts give you the right to sell a specific amount of stock at a fixed price known as the strike price on or before an expiration date. Again, if you're a buyer of put options, what you pay for it is the maximum you can lose, okay? And you decide if and when you ever exercise that option. Now, when we talk about option premium, or that price that you pay for that contract, here's how it is calculated. First of all, one contract is the equivalent of 100 shares of underlying stock. So if an option contract was trading at $1.50, the way you would calculate it is you take the number of contracts that you're buying. In this example, it's one. Multiply that by 100, because one contract is the equivalent of 100 shares. So 1 times 100 times that 150. So your cost would actually be $150. Okay, so again, a lot less expensive than it would be to buy 100 shares of stock in most cases. Now, what type of options can you buy? when it comes to equity options, options on stocks, there's literally thousands of optionable stocks out there with different expiration dates, monthly, weekly, and even LEAPS that you can buy option contracts that expire a year or two from now. You can buy options on an index like the S&P 500, like the Qs, like the Dow, etc. You can buy them on futures contracts like crude oil, gold, wheat. You can buy it on coffee, on cotton, you name it. Just about everything has an option contract these days. Now, the terms you need to be familiar with before you start trading options are in the money, out of the money, and at the money. Let's start with in the money. In the money, what we mean by that is when you purchase a strike price that is below the current market price of the underlying stock, in the case of calls, that is in the money. So what you will find is there's a couple of components that make up the premium, that price you pay for that contract. There can be an in the money amount and an out of the money amount. Okay, and so this is what we're talking about when it comes to in the money, some real value. So if the stock was trading at 25 and you purchased the $15 strike call option, that is the $15 call on a $25 stock, you are effectively $10 in the money. If you bought the $35 strike, okay, and the stock was trading at 25, that's when you would be out of the money. So a call option with a strike price that is higher than the current market price, that's out of the money. And the strike that is closest to the actual market price of the security, in this example would be 25, would be the at the money strike. Okay. Now, that at the money portion that we talk about, or sorry, the in the money portion, that real value portion is also known as intrinsic value. Okay. Again, if we have a $15 strike and the stock is trading at 25, there's $10 of real value, or otherwise known as intrinsic value. The extrinsic value is the out of the money portion, and that is what we refer to as time value. So think of it this way: if your option, that $15 strike call option, was trading for $12, okay, $12 of premium. Well, from 15 to 25, which is the current market price, that's $10 of in the money amount, right? The extra $2 is out of the money, or time value. Now, the more time to expiration you have, the bigger that time value component would be. So the more expensive the option would be. When we get to the option chains, you'll see it clearly. Bear with me here for a moment. Now, the other thing that you have to understand is implied volatility. And when a lot of people think of implied volatility, they think about the volatility of the actual option itself. That's not the case. What you want to always look at is the estimated volatility of the underlying stock, that underlying securities price. Right? If you're trading futures contracts, then it's the underlying futures contract, etc. But in general, what you'll notice is that when the market is going higher, we are normally in a low volatility environment. There's no panic. Everyone's happy. The market's going higher and volatility is low. It's usually a slow, steady climb higher. But when the markets drop, especially on a day like today, this is when you will get a very big spike in implied volatility. When the market sells off, whether it's a particular stock or an index, when it's selling off, and especially when it's selling off hard, people tend to panic, more orders come in, and that implied volatility component increases. Okay. Now, here are a few facts about options. First of all, as I mentioned at the beginning, they're only risky if you don't know how to trade them. When you do know how to trade them, these are very, very safe and very effective. Another fact is that over 80% of option contracts expire worthless. Now, why is that? That's where that implied volatility component comes in. Most people buy options. Very few sell. Most people buy, but they do so without taking fair value or implied volatility into consideration. In other words, what ends up happening is that even though they are correct on the direction of that underlying stock, they still lose money because they overpay for that option contract to begin with. When you don't understand fair value and implied volatility, what happens is you tend to overpay for an option, and even though it goes, in your direction, you still end up losing money. So here's the couple of slides that I really want you to understand today. When it comes to the price of a stock, okay, from the day you buy it or sell it, only 5 things can happen. Okay, it either goes in your favor big time, it goes in your favor slightly, it does nothing, it just consolidates, price remains the same, it goes against you slightly, or goes against you big time. Those are the only 5 possible scenarios out there. There is no other possible scenario. So when you're buying an option, if it goes in your favor big time, of course you're going to make money. If it goes in your favor slightly when you buy an option, you may make money. And this is where that implied volatility component comes in, and that fair value component. So if you overpaid for your option, even if the stock went your way slightly, you'd still lose money. Now, if you paid a fair price for it, or even bought it when it was undervalued, yes, you'd make money. When the stock stays the same, you're going to lose money on that option contract. Why? That time value component. As the days go by and you get closer and closer to the expiration date, the time value component of that premium will erode. Okay, it'll go away. So you will slowly but surely lose money every day that you hold that option when the stock doesn't move. Now, if it moves in the wrong direction, if it goes against you, of course you're going to lose money. And if it goes against you big time, you'll definitely lose most, if not all, of your money in that option. So, best case scenario, if you understand fair value and implied volatility, you have a 2 out of 5 chance of making money. But in most cases, people don't understand how to value those contracts. And so right from the beginning, as they buy that option contract, they have a 1 in 5 chance. In other words, 20% chance of making money, 80% chance of losing money. And that is why 80% of option contracts expire worthless. It's a fact. Okay. Now, when you're selling an option contract, as far as the underlying stock goes, the same 5 scenarios can happen. Nothing else can happen. But when you're a seller of option, if the position goes in your favor, you'll make money. Of course, you'll make money. If it goes against you slightly, you'll still make money, because now that time value erosion is in your favor. You sold it, right? It's just like shorting. You're selling high and you're buying back low. So you want that erosion because it's in your favor. If it's going sideways, again, that time value erosion works in your favor. If it goes against you slightly, you can still make money, again, because of that time value erosion. If it goes against you big time, then you'll lose money. So when you're a seller of options, you have a 4 out of 5 chance of making money, or again, an 80% chance of making money, 20% chance of losing money. So at first glance, you'll look at these 2 slides and think, well, obviously I should only sell options. I should never buy options. Not necessarily true. Here's the thing. It is true when you talk about probabilities, but when you're a buyer of options, remember, you control the risk. You decide how much you pay for that contract, and you can never lose any more than that, okay? But your profit potential is unlimited. When you're a seller of options, you're very limited because the premium you collect is the maximum profit you can make, yet your risk can be unlimited. So when you're a seller of options, yes, the probability of making money is 80% or better, but when you make money, you make very little. When you lose it, you lose big. When you're a buyer of options, yes, your probability of making money is a lot less, but when you make money, tends to be very high compared to when you lose money. So those are the things you have to understand. And here, one last chart, the time decay. What you need to understand is that if you're going to buy options, you want time in your favor. Okay? You want as much time as possible to expiration. Why? Because that time value component that erodes as you get closer and closer to expiration, when you're far from expiring, the erosion happens very, very slowly. So you hardly notice it at all. Giving your stock that time it needs to move and actually make you some money. And while the time value here erodes slowly. But as you get close to expiration, and especially in the last 30 days, that time value erosion happens very, very rapidly. So if you're a buyer of options, you want to buy as much time as you can. If you're a seller of options, you want to only buy an expiration date that is about 30 days, maximum 40 days to expiry, no more than that. Okay, so you want to sell that option so that you can collect that premium, have that option expire worthless, and keep your full profit. Okay. Now, there are many strategies out there. There's dozens of them. Long calls, puts, protective puts, butterflies, covered calls. Today, time permitting, I'm gonna just talk about long calls and puts and callers here, just to give you a little taste. But the key here is to understand that when and how you use each strategy is what matters, not that you use them all. In fact, you don't want to use them all. You only need to use the ones that make you money. In other words, learn one or two that you're very comfortable with, understand them fully, and then if you want to expand your knowledge, you can go to others. But you only need one really that works for you to make money. So let's get to the charts here and talk about strategies. So I'm going to just use Nike as an example, okay? Now, Nike to me is fairly neutral right now, but let's just assume that we believe that Nike was going to bounce from here and go higher. Well, we can buy the stock, but it's trading about $75. So even if we bought 100 shares of stock, it would cost $7,500, right? So that's one option. But if we buy a call option instead, let's go out to April, buy ourselves a lot of time here, 135 days to expiration. Let's go on and buy a call option. Now, even if we go at the money and buy that $75 strike, it's going to cost us about $6. 6 times 100, right? One contract, which is the equivalent of 100 shares, times 100 times 6, we're talking about $600. So big difference, right? There, if you buy the stock, $7,500 you have to put up, and that's fully at risk. If you buy an option contract, which is the equivalent of the same number of shares, you're spending $600, and that's the maximum you can lose. So now there is flexibility in owning the stock. Sure, you can do other things with it, like selling calls against it, etc. But just up front, first of all, if you have a smaller account, much smarter to trade options. But secondly, from a risk perspective, imagine buying a call option on something that dropped like the Dow did today or the Nasdaq, right? The maximum you can lose is 600. There's no more pain beyond that, as where if you were to just buy the stock and it takes a drop like you get hit, you take the full hit. So now, so that's one option. If you think it's going down, you can just buy a put. Go on the other side of the column here and buy a put. Now, by the way, what you see here, the shaded areas, the yellow shaded areas, those are in the money because the call options here, the strikes that are below the current market price of the stock, which is 75, are in the money. And over here in the white is the out of the money portion. So remember, for example, if we take the $70 strike, that's in the money, right? The stock is trading at 75.79, and we have a 70 strike. So if we pay $9 for that contract, it's already $5 in the money, right? So that's $5 of real value. The rest, the other $4 of this premium, that's what we consider time value. So between now and 135 days from now, April of next year, okay, if the stock remains at 75, that time value component will slowly erode, okay? And over time, we will lose those $4 of time value. But as long as it stays at 75, we'll keep our $5 of real value. Now, if we go to the 80 strike, for example, and pay $370, $380 for this, that's all time value. There is no real value. So over time, if the stock doesn't get above 80, we will lose all of that as it will erode, okay? Now, so just a brief scenario of how much safer they are when you're just buying calls and puts. Now, they get a lot more complicated. There's many strategies. I want to show you one quickly here, which we call a collar trade, which is where you're buying the stock, you're buying a put to protect it, and you're selling a call against it to bring in some extra premium. And I want to do it with LEAPS. So if we go to Nike here and we go out to the expiration that happens in January of 2020, so a little over a year from now, we have plenty of time here. Okay. And now let's say we buy the stock at 75.79. We buy the 80 strike put. What that does is give us the right to sell it at $80 anytime between now and January of 2020. So now we are paying a little over $10 for the right to do that, to sell it at 80. But think about it. If we pay $75.79 for the stock, plus we pay 10 and change for the option, what's our total cost? $86, right? In total. That's our total cost is $86. But we have the right to sell it at 80. So in other words, we only have a risk of $6, right? So now we've set ourselves up with we're giving ourselves over a year for the stock to move higher, right? And make us money, but we've locked in a risk level. We cannot lose any more than $6 on that trade. Now, what if we went here to the calls and we sold a call option against it for $8? Now we go from a cost basis of 86. Once you remove $8 from that, now we're at a break-even point of 78. So we've actually spent $78, right? The 75.79 plus the 10 and change here, that gives us 86 minus 8. We're down to 78. But we have a right to sell this at 80. Okay, and if the stock moves higher and gets above 80, we're going to get exercised anyway, again, at $80. So no matter what, we can get out of this at $80, no matter what. Okay, so what we've effectively done is locked in a $2 profit right from the beginning. There's absolutely no risk to this at all. We've already locked in a $2 profit. The other thing is, now it may not seem like a lot, right? You lock in $2 for a year on a $75 stock. The other thing is it pays a dividend. Pays an annual dividend of 80 cents. So we're going to collect at least 80 cents in dividends throughout the year. Now we've got a profit of 280. Percentage-wise, that's a little over 3%. Okay, so this is just one example. There are many out there like this, and many that pay a lot more than 3%. But when you truly learn how to trade options, one of the real benefits is how you can adjust these contracts and these strike prices throughout the life of the order. So as Nike fluctuates between now and January of 2020, we will most likely be able to rejig this position and end up making a lot more on it by the end. Don't have any more time here to explain it to you today, but in a minute I'll tell you about a course where we will teach you how to do all that. But at a minimum, you've locked in already $2.80 of profit. You have absolutely zero risk on this trade at all. So that is the benefit of options. And there is a lot more to it. Now, let me briefly tell you about the pro course we have for our high-octane options training. Now, if you go to tradingwins.com/black, and the reason we have /black here on our URL is this was our Black Friday special. And we thought we'd extend that to you today because it was very popular. Go to tradingwins.com/black and it'll take you to this page where it'll lay out exactly what you're going to get for just $7. So initially this was expected to be a 2-hour live training course. We've already did that 2-hour component. We found we couldn't cover all the material in that. We're going to have a second session next week. So this will end up being about a 4 to 5 hour training course. You're going to get the recordings of all of it, and you'll be able to join us live for the second portion. But during that class, I'm not only going to elaborate on straight calls and puts and that collar trade that I talked to you about, I'm also going to show you how you can consistently make money selling credit spreads, how you can use what we call a butterfly spread to take advantage of some rare events that happen in the markets. The beautiful thing about butterfly spreads is usually you're risking 1 to make 9 or 10. That's the risk reward ratio. So in this example where I say risking $90 to make 1,000, it's reality. You find these situations all the time, and I'll show you how. Now, also during the times when the markets are consolidating and going sideways, I will show you a couple of different delta neutral strategies where you can take advantage of that. And even during flat times, be making some money. I'll also along the way share with you a couple of repair strategies. So when trades don't go your way, there are certainly ways that you can rejig those options and minimize your loss. In some cases, even turn them into winners. In addition to that, we're going to talk about trading LEAPS. We talked a bit about it today. There's going to be a lot more discussion on trading LEAPS, how to take advantage of those. And as a bonus, I'll throw in a 30-day membership to our TradingWins Pro service. This is where we send you videos 5 times a week recapping what happened in the markets that day, where we think things are going, and that's where I share some trade ideas with you. We also, with our members, meet twice a week, every Monday evening and every Thursday morning. You'll be able to come into our room live, ask me any trading related question you want. I'm there to help you take your trading to the next level. All of those sessions are recorded and put in your own video library as well. And as well, every month for our pro members, we do what we call our course of the month at no extra cost. So you'll get that as well. Now, I didn't have time to demo it today, but as part of this package, you'll also receive a 30-day membership to the Tactical Trader platform. Let me just show you quickly the Tactical Trader platform. It's a charting platform that has some unique tools like seasonality, where it'll tell you. So here for Nike, for example, going back to the year 2000, during the month of November, there's usually a 79% chance of about a 3% move on Nike, and etc. Now, I'll during those other sessions, I'll show you how to use these as well. And there's an earnings tool as well, a Fibonacci tool where it drives in the Fibonacci tools automatically for you. All of that. So we're limited in time here, but you'll get 30 days to play with that tool and use all of those at your leisure. Okay, and so all of that for just $7, obviously not a moneymaker for us. We want you to just see what we do here at TradingWins. So go to tradingwins.com/black, and you get all of this for just $7. But trust me when I say, if you haven't traded options yet, you definitely want to learn to trade options. And if you have, you know exactly what I'm talking about. They allow you to trade much, much safer and allow you to really leverage your positions in a very, very safe and consistent way. If there were any questions, I apologize, I'm out of time. You can send me an email at info@tradingwins.com, info@tradingwins.com, and just put attention Vince. It'll get to me and I'll respond to you, okay? With that, I will turn it back to our host. Dave, thank you very much for having me back on. Hopefully we can do it again soon.